Hello and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we step back from the noise to unpack the developments shaping credit, explore the macro forces behind them, and discuss what they mean for investors and issuers across Europe and the UK. This week we're looking at a series of papers and policy updates that highlight rising concern among regulators and central banks. From fiscal challenges in the UK and France to the Bank of England's renewed focus on non-bank financial risks, to the ECB's research on insurance sector vulnerabilities. There's no shortage of issues shaping 2025, and as we head into the year end, it's worth preparing for a potentially eventful year ahead. All right, let's get started. Last week's much-anticipated UK budget finally arrived, and after heavy press speculation, the outcome was surprisingly muted. Labour had the political space to pursue more sweeping tax reform or introduce bolder pro-growth measures aligned with their early mandates. Instead, the result felt more like a buy now, pay later budget. The government spending is set to rise, particularly welfare spending, while tax increases are pushed into the future. The messaging centers on growth, but the mechanisms rely on front-loaded spending and delayed consolidation. My main concern is the increase in the minimum wage. The Bank of England's Monetary Policy Committee has held rates high because inflation, particularly services inflation driven by wages, remains above target. Raising the minimum wage adds pressure to this component. Last year's tight pass-through from the national insurance increase showed how wage-linked costs filter rapidly through the economy. Add to this the business rates changes, and the impact on retail businesses is likely to filter through to increase prices. The government has attempted to offset these inflationary impulses with cuts in energy bills and a freeze in rail fares. But targeted price interventions rarely offset the broader wage price dynamic. With inflation expectations still elevated, the disinflation path is likely to remain uneven. Despite this, markets expect the Bank of England to cut rates at its next meeting on December 18th, and the ECB meets the same day and, unlike the UK, is widely expected to hold rates for now, despite a small but surprising rise in euro area inflation to 2.2%. The UK was not the only country with budgetary challenges. Turning to France, fiscal stress is brewing. The government faces a crucial vote next week on welfare spending, and French government bond yields remain elevated. Compared with the UK's budget process, France's situation is much more politically constrained and arguably more challenging. Monsieur Lecornu has been negotiating incremental compromises to keep the budget on track. The main budget bill won't return to the National Assembly until later in the year, but next week's vote is a critical early hurdle. The fiscal path ahead remains narrow. Now let's turn back to the UK with the Bank of England, which has released several notable items recently. First, the latest stress test results show that UK banks, especially larger systemic institutions, remain resilient, even under adverse scenarios. This reflects a decade of stronger balance sheet management, higher quality capital, and Basel-driven buffers. As a result, the bank is cutting the system-wide Tier 1 capital requirement from 14% to 13%, freeing up capital for increased lending just as rates begin to decline. This is a very constructive development for credit supply. Second, the bank's December 2025 Financial Stability Report underscores the strength of UK banks, but also highlights rising systemic risk in market-based finance. Several interconnected concerns stand out. Valuations in AI and tech sectors appear stretched, and the bank sees rising vulnerability to correction. Recent market pullbacks support that concern. High-growth firms have become increasingly reliant on debt, raising potential spillover risks into broader credit markets, especially with spreads tight. Non-bank financial institutions, particularly private credit and leveraged lending, are expanding lending with compressed risk premia and higher leverage. The bank's view is not that distress is imminent, but that systemic risk has migrated from the banking sector into less regulated, more opaque corners of the market. Now, We would argue that private markets with patient long-term capital and more bespoke underwriting are often better equipped to assess and absorb credit risk than banks constrained by short-term liquidity and regulatory pressures. Opacity is a genuine concern, but transparency is improving as participation grows. And KBRA has been a provider of that transparency via our research reports and KBRA DLD, which reports on activity in the private credit markets. Broadly, corporate leverage remains moderate by historical standards. Corporate net debt to earnings in the UK stands at 134%, well below the 166% during COVID and 230% after the GFC. Still, unknown unknowns in parts of private credit justify supervisory attention. This leads to the last item recently released, and that's the bank's new exploratory scenario in 2026 for private credit. Large firms, Blackstone, Apollo, KKR, Ares, and CVC, have all agreed to participate. The goal is to understand how private credit vehicles would respond to a severe shock and how stress might spill over into public markets and the banking system. This is not about predicting failure, it's about mapping interconnections that regulators have historically lacked visibility into. Now, let's turn to the European Central Bank, which published a discussion paper on the 2nd of December examining euro area insurers and their asset allocations and the macro-financial implications. Insurance companies are among the largest institutional investors in Europe, holding vast quantities of sovereign, corporate, and bank debt. Their behavior matters, particularly given the following trends: a shift towards illiquid assets, the use of sovereign bonds as liquidity anchors, the risk of increased non-life insurer claims, the impact of quantitative easing from the ECB, and the risk of increased fragility in the face of adverse scenarios. Years of low rates pushed insurers, especially life insurers, into less liquid, higher-yielding assets: mortgages, loans, real estate, and illiquid corporate credit. This improved yields but reduced portfolio liquidity. Despite the shift, sovereign bonds remain central because they are highly liquid, favorably treated under regulation, and well suited for matching long-term liabilities. Home bias remains strong, which then concentrates this sovereign risk into the country of incorporation. Non-life insurers facing rising climate-related claims may need to liquidate sovereign bonds quickly to meet payouts. That selling, particularly of domestic sovereigns, can transmit shocks directly into government bond markets. Post-GFC quantitative easing made sovereign bonds abundant and compressed yields, and insurers responded by reallocating roughly half of each 1% increase in sovereign holdings acquired by central banks was offset by insurer flows into alternative assets, including more corporate and bank debt. The ECB paper concludes insurers are structural anchor investors, but their tilt towards illiquidity creates vulnerabilities. In stress scenarios, rising yields, economic downturns, or climate disasters, they may be forced sellers, potentially amplifying volatility in sovereign, corporate, and bank-issued debt. And as the UK learned during the LDI episode under Liz Truss and Kwasi Kwarteng, concentrated forced selling can move markets very quickly. On the flip side of that, as we have transitioned to a higher-yielding environment out of that QE compressed market into a quantitative tightening environment, the appeal for more liquid and higher-yielding sovereign and corporate credit markets should remain strong in 2026. So, where does that leave us this week? Well, we have several themes pushing through. Fiscal pressure persists in France and may return for the UK, which may weigh on economic activity as businesses adjust to evolving policies. Financial stability is diverging, with banks that are well capitalized and resilient and riskier lending shifting into non-banks, private credit, leverage lending, and market-based finance. Credit markets may face greater tail risk, particularly in high-yield leverage loans and private credit segments where valuations are elevated. Banks' capital relief may support lending, benefiting investment-grade borrowers and middle market firms. Insurance sector behavior matters more than ever. A large climate or catastrophe event could have outsized effects on sovereign and credit markets due to forced asset sales in a search for liquidity. Higher yields should drive an improved allocation to more liquid markets in the near term. The outlook points to increased credit bifurcation, stronger conditions for higher quality borrowers, and more fragility for riskier credits. And the trigger for any shift, whether a valuation correction, climate event, or macro shock, could reverberate through local government bond markets. However, as we stand now, credit is performing well, albeit highly valued. Growth is slowly returning to Europe, and the market remains quite attractive with strong yields. So, in summary, systemic risks remain present, but credit performance remains resilient. That's all for this week's edition of the Credit Compass. If you found today's discussion useful, follow, rate, and share the show. It really helps others discover it. And if there's a topic you'd like us to explore, please drop us a line. We're always open to listener ideas. For deeper insights and data-driven analysis on macro and credit trends, visit kbra.com/macro credit, our dedicated hub for all things macro, markets, and credit dynamics. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.